Mr. Piramal, always a pleasure chatting with you. Congratulations on a stellar set of results. I believe this is the strongest top-line growth that Piramal Enterprises has seen in the last 16 quarters. Give us a sense of what were some of the major growth drivers and which segments stood out in terms of performances.
So this quarter we've grown at 46% compared to the previous quarter, and for the whole year our growth has been 34% in terms of the top line, and today we are at 8,500 crores. We are in three large segments: financial services, pharma and information services, and I'm happy to say that all these three segments have contributed very well to the growth. The financial services, the growth rate has been 90%. In pharma for this quarter, it has been 31%. And for DRG, our information and data analytics space, it's been 10%. I'm particularly happy to say that even the profits have gone up, and we've had record profits in this year. For the quarter, our profits have gone up by 61%, the net profit to 311 crores. And the net profit for the whole year at 1,250 crores has gone up by 38%.
Mr. Piramal, you spoke about financial services. Now, clearly, that's increasingly becoming a bigger pie of the entire conglomerate. You spoke about the fact that it clocked a very, very healthy growth rate of 90% in this quarter. Linked to that, of course, is the other big decision that has been taken by the board, and that is, of course, to raise funds up to 5,000 crore rupees. Give us a sense of what is the rationale behind the fundraise, and is it aimed at perhaps fueling more growth in the financial services segment?
We are in, as I said, all the three segments: pharmaceuticals, financial services, and information and data. We are fortunately in a space where we are seeing good growth rates in all of these spaces. The fundraise would be used, yes, for financial services, where we are seeing a very healthy increase in our loan book. In fact, if you see our loan book and the quality of assets that we have has been really good. Return on equity for our loan book has been at over 25%. The gross NPA levels are only 0.4%. And our book today is about 25,000 crores as on March 31st, 2017. So there is a good demand in this space, and we have also gone into housing finance, as I said. Therefore, the requirements are there for financial services. In pharmaceuticals also, in the last year, we've made several acquisitions, and these, as we look at into the future, we feel that there is a good potential to grow in these areas as well. Just for example, in consumer, the OTC space, which we are in India, most of the people were affected by demonetization. But in spite of demonetization, we've had a growth rate which is in excess of 40%.
Sure. So we'll keep a close eye out on the deployment of these funds in the days to come and how it spreads out across various sectors. But financial sector services seems to be the major segment.
As well as pharmaceuticals will take some of that.
Sure. All right, sir. Now, another aspect or another segment, in fact, where you have exposure to is stressed assets. And recently, in relation to that, we saw the government coming out with an unprecedented move. The RBI has now been given greater powers to, direct stressed asset resolution as part of banks' procedures, and also, in fact, initiate insolvency proceedings as and when it deems fit. But, sir, the one buzzword in the banking circles is this creating a conflict of interest? Because this seems to perhaps demonstrate that the RBI has more commercial expertise than banks themselves. What's your take? Because there are two sides to this debate.
No, I think one thing is that we have to recognize that the level of stressed assets in the economy is very high. This has been on the top agenda, I can see, of the government right from the time that this government has taken over. It's been the top of the agenda of the Reserve Bank as well as of all the banks that you talk about. I think what the RBI has done is really to insulate to some extent the decisions that the banks make to be actually governed between RBI and the banks, rather than getting many other authorities coming in. One of the big constraints I thought about, the banks were hesitant to take decisions on the amount of write-offs that you would have had to do for an NPA would be the fear, as they say, of the 3 C's, whether it's the CAG or whether it's the CVC. And so these issues, I think it's taken, the RBI in fact has taken the onus on itself for quick resolution of this. And I think it's a step, a bold step, it's in the right direction, and which will only encourage more resolution of the problems. And this is where even people like us who have now got this stressed asset fund, there will be actually quicker resolution and therefore greater opportunity.
Sure. Would you then perhaps concur with the school of thought which seems to believe that post this ordinance, the fear factor amongst public sector banks has perhaps moved to a comfort factor of sorts?
Definitely the fear factor in the banks will have gone down. That's the impression I get talking to some of the banks post this ordinance being passed.
That's great. So one more aspect, and this is, a wake-up call that came in all of a sudden from the chief economic advisor when he said recently that analysts, experts and banks are bending backwards to be in the good books of the regulator and the government. Now, that was quite a sudden statement. What do you make of this observation coming in from an authority as high as the CEA?
So it just shows that, I think the Reserve Bank is now pushing that you have to solve the NPAs, or the recognitions will be much more sterner, faster than what it was before. And therefore, the banks will need to fall in line to understand that the Reserve Bank is becoming tougher on recognition of NPAs, and hence resolution of NPAs is what needs to be done.
So 2 quick questions before I wrap up. You hold 20% stake in Shriram Capital, which is of course the holding company of the Shriram Group. Now there's been talk about you perhaps hiking that stake to a majority stake. What's the progress on that front? Can we see that fructifying this year, sir?
So we have no plans to increase our stake in Shriram. I think Shriram, the stake that we have is a significant enough stake for us, and we think that Shriram actually is in the best sectors where there is a lot of growth, whether it's in the small and the medium scale, which is a big thrust which the government has, and I think that we have a good enough stake there.
All right. Last question, sir. Whenever I speak to you, unlock shareholder value. That's perhaps been the common, the common refrain whenever there are interactions with the group, because the market capitalization of the group has really gone up in the past many years. Coming to avenues in which you could perhaps further bolster that market capitalization, are you looking at perhaps IPOs for any of your group companies to add to that already existing market capitalization?
Actually, if you look at the track record that our company has of market capitalization, it's been quite a good track record. We entered this pharmaceuticals in 1988, and for the last 29 years, if you say, we've had a CAGR in creating market value of 30% year on year. So if you had invested ₹1 lakh in 1988, and if you continue to remain today, the value that you would have would be about 18.5 crores. So that's a good way. If you can see, there are very few companies which have delivered a 30% CAGR over a 29-year period. So we hope that we can keep up with the past track record that we've had in the future.
So to my question on whether you're exploring any IPOs for any of your existing units, that's of course to add to the already existing market cap.
I think whatever we do would be in the best interests of long-term interests of shareholders.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.